gentlemen, for joining in on the show. Dr. Narayan, we've got a cool off from the rally that we've been seeing over the last 2 days, but still options build up is indicating that this is not, we've still got a lot more to cover up on the upside.
Yes, I would tend to agree with that. The option build up over the last 3 sessions in particular has been very, let's say, aggressive on the shorting put side, which would be suggestive of the markets wanting to seek even higher levels. But in the light of that, we should also be looking at where the resistances lie on the upper side, and I think 55, 60, 65 was the first one, and that is where we have halted for the day so far. But I think the stronger resistance band is actually coming up through 55.85 to 5610, and I do think that will be a pretty stiff band that the market will find difficult to exceed. So if one is long, then probably one should actually think of taking off some of the positions there, if not all of it. But I do think the pace will be much slower now, which is probably why, as you mentioned a while ago, that 5500 calls and puts are becoming active. I think lots of straddles and strangles are being put on at 5500 for June, and 5455 or even 5456 for June series, in the expectation that the market would probably halt somewhere very shortly and would try to finish somewhere around the 5500 levels, making these straddles as well as strangles somewhat profitable. I think that is what is going on right now. So not as gung-ho as it was earlier, but certainly not giving up what it has sort of accumulated over the last 4 sessions.
Right. So in that light, what kind of a strategy would you adopt now? I believe you're going synthetic short future in anticipation that you would see the markets come down further?
Yeah, I have 2-3 reasons for this. One is we are sort of adequately positioned for the long side with a long 5500 call, which is something I suggested as of yesterday. So having taken care of the upside, I would now like to concentrate on the possibilities that I mentioned earlier, that around 5580 to 5600 we would probably run into resistance, and if it were to happen, we still have another 2 clear days for expiry. You might have a pullback to somewhere closer to 5480 to 5500. I would like to make a small play for that. For that, I am actually recommending a kind of a slightly hybrid synthetic short. I would want to short a 5600 call, which is trading around 11 to 12 rupees, and then set this off with 2 longs of 5400 puts, which are trading at about 6 rupees. Now, I'm not really taking this into expiry. Mind you, these, short the call and long the put, you don't really have a, you don't really have a trading cost here, because what you receive in the call is the same as what you, what you would end up sort of paying for the put. So you don't have anything that you are actually going to pay to own the options. So this is therefore a free sort of strategy. The only caveat being that if the market were to go aggressively higher and we have a closing above 5590, let's see, that is where I would put a stop and close out the short 5600, which we'll be going short at.